So gifting money is what we're talking about today. And there might be various people in our lives that we want to make financial gifts to in our lifetime. It could be our children to save for their future. It might be to friends and family who are getting married or need some help to get on the property ladder. Or you might have other reasons. You could just be conscious that we get into the end of a tax year and want to make the most of the savings allowances that the governments afford us, some of which we can't carry forward to the next tax year, things like ISA allowances. But whatever our reasons, did you know that there are invariably tax implications of giving financial gifts? And the reason for that, the reason we pay tax on gifts, is that it's the taxman's way of making sure that we don't all try to avoid inheritance tax by giving all of our money away just before we die. So the purpose of this session is to look at which financial gifts we can give without paying tax and which we can't. Because of that, we are going to have to look at the inheritance tax basics. Then we're going to move on to some of the financial savings products that you can make gifts into, things like ISAs and pensions. And we'll also look at giving money to charity as well. And then we're going to finish off by just going through why a will is so important and how we can use that to give gifts away after we've died as well. And then we'll have some time for Q&A at the end. So let's start then with tax-free gifts. So making a money gift to our friends and family while we're alive, it can be generous, it can be a helpful thing to do, but it can also be a good way to reduce the value of our estate for inheritance tax purposes. And it benefits our loved ones immediately, which is fantastic. So let's have a look, run through the gifts that you can make during your lifetime that are free from inheritance tax. So firstly, we're allowed to give our spouses or our civil partners as much money as we like without triggering any inheritance tax liability, as long as we're both UK based. If your spouse or your civil partner is not UK based, it's going to depend on the rules in the country that they reside in. So you would need to look those up. The other thing that would be free of inheritance tax is that we do have an annual exemption of £3,000, and we can gift that money to whoever we please without triggering a tax liability. We can also make unlimited additional small gifts of up to £250 per person, things like giving money to family for birthday or Christmas presents. And as long as these gifts are from our regular income, then they qualify for that tax exemption. We're also allowed to make tax-free gifts when people get married. And how much we can gift completely depends on our relationship with that person. And as you can see, so if it's a child, we can give £5,000 tax-free. If it's a grandchild, £2,500 tax-free. And for anybody else, it's £1,000. But I thought I would just mention, particularly in today's times, that we do need to be beware, because if that wedding or that civil partnership is then called off and you've already made that gift, it will no longer be exempt from inheritance tax. In addition, you can make regular payments out of your income as long as it doesn't affect your normal lifestyle for things like saving for your children under 18 or to help with living costs for dependents, people like elderly relatives. And also maintenance payments that are due either to you or to somebody else after a separation to support an ex-partner or children is also exempt, as is grandparents paying for grandchildren's school fees. Lastly, you don't pay any tax if you gift money to registered UK charities, to sports clubs, universities, museums, or political parties. But those sports clubs must be registered as a community amateur sports club. So there you go. They are all the things, all the gifts that you can make that are definitely exempt from inheritance tax. And if you want to read a little bit more about that, there's a really useful guide on making gifts to family and friends on the Money Helper website. And I've put that website address at the bottom. So what happens then if we decide to make a gift that falls outside of those exemptions, or we decide to pay more over and above what's allowed? And you can do that, of course. Well, the likelihood is that there might be inheritance tax to pay on that gift, but that inheritance tax becomes due at the point that you die. So whoever makes the gift at the point they die, that's when the inheritance tax becomes due. Now, if you live more than 7 years from the date that you made the gift, then there's no inheritance tax to pay on that gift. And it's known as potentially exempt transfer. And the reason for that is the taxman will think, well, they didn't just do it to avoid inheritance tax. It was a bona fide gift for a particular reason. However, if you don't live more than 7 years after the gift is made, then inheritance tax must be paid by the estate on the gift that you made. And how much will depend on a sliding scale, as you'll see down that right-hand side of the slide. So let's say, for example, you made a gift of £10,000 that was over and above your annual exemptions, and you made that gift 4 to 5 years before your death. It wasn't exempt. You'll need to pay inheritance tax of 24% on that gift. So that would amount to £2,400 worth of inheritance tax that would need to be paid on that £10,000 gift. Now, the other reason that inheritance tax wouldn't be paid is if the estate of the person who's died, and an estate is just simply all the assets and possessions that they've got added together, along with any gifts that they've made in that last 7 years. If all of those things add together amount to less than £325,000, they will be exempt again from an inheritance tax. And that's because that £325,000 is our inheritance tax permitted allowance. That's per person. Now, our individual tax allowance for inheritance tax purposes can be higher if you leave your house to a spouse or a child. It means that you get an additional allowance called the residence nil rate band, and that's added to the 325, and it brings up your threshold to £500,000. So if your assets don't add up to your total inheritance tax allowance, then even if you did make gifts over and above your annual exemptions, there will be no inheritance tax to pay. Now, you might be sitting there thinking, well, that's all very well, but how on earth does the government actually know, what my threshold is, whether I passed on my house to my child, and if I'd made any gifts? Well, when somebody dies, the executors of the will have to go through a process called probate, and this deals with the assets that have been left by the deceased. And part of that process is completing forms for HMRC that has to declare what assets that person had at the date that they died and whether they made any gifts in the 7 years before their death. And of course, if the executors of the will lie on these forms, then that is fraud. If you are an executor, you can complete the forms yourselves for somebody that's passed away, and you can find them on the gov.uk website, or you can ask a solicitor to do them on your behalf. Now, if there is any inheritance tax due on any gifts that were made, or on the estate itself, that would normally be paid out of the money that's left in the estate rather than the person who actually received that gift. The exception to that is if you were personally given more than £325,000, which would have been that person's allowance, then it may well be that you have to pay that inheritance tax personally. If you want to read up a little bit more, I mean, this is quite an in-depth subject, and certainly we can't go into all of it today. But if you want to read a bit more about inheritance tax, I have added the gov.uk website address where you can find some more details. And if you feel that you need some help with inheritance tax planning, maybe you're planning on giving some big gifts away, then this is something that a financial advisor could help you with. So I've just put the unbiased.co.uk website there. That's a great place to start if you're looking for that type of advice, to find an advisor who's regulated and got the proper exams. So go on there. Or the other alternative is to ask friends and families for advisors who they might have used that they found helpful. So that's the most complicated part of gifting money we're going to talk to you about today. But now we're going to move on to junior ISAs. And junior ISAs are a saving product that you can pay into for a child if you don't just want to give them a cash gift, if you want to give them a gift that helps them to save for the future. Now, junior ISAs are long-term tax-free savings accounts for children. And a key reason for opening a junior ISA is that any interest paid or any investment returns that child gets on those savings are completely tax-free. Now, if as a parent or a step-parent, you contributed to a child's savings in a bank account, they're actually only allowed to earn a maximum of £100 interest a year, before you get taxed at your highest rate on any contributions that you've made for them. And that £100 of interest is regardless of how many children you contribute into a bank account for. It's split between them all. So getting around that, gifting into a junior ISA means that any interest they get is tax-free and you don't get taxed as the parent. Now, in the 2021 tax year, the savings limit for junior ISAs is £9,000, but of course we are rolling over into the next tax year on the 6th of April, but the savings limit is going to stay the same. And that £9,000 can be spread across a cash junior ISA, or alternatively, if you wanted to invest for the longer term and get potentially higher returns, you could get a stocks and shares junior ISA. Now, it's also worth knowing that if you've got children who are aged 16 or 17, they can actually open their own junior ISA as well as opening an adult cash ISA. So you only have to be 16 to open an adult cash ISA. So just for those 2 years, those children have a total ISA limit of £29,000, £9,000 for the junior ISA, and £20,000 for the adult cash ISA. And that doesn't happen again. Once they get to 18, they can only have the adult allowance. Now, if you wanted to use the junior ISA for inheritance tax planning, the easiest way for you to do that is to set up a regular amount each month into the junior ISA for that child or that grandchild as a gift out of income. Because as we said before, if it's a gift out of income, it doesn't affect your lifestyle, then these payments can be exempt from inheritance tax. Alternatively, you could use the £250 small gifts allowance, or you could use your £3,000 annual gift exemption to pay into a junior ISA. But it is worth remembering, however, that whilst parents or guardians with parental responsibility can open a junior ISA and can manage the account, once that child gets to 18, it does become their money and the ISA converts to an adult ISA. So you're not going to have control over how that money is spent. So if you're going to do a junior ISA, try and see if you can give your child some education before that money becomes theirs, to tell them what you intend for that money to be for and how they can budget and use it sensibly. You might have had plans for them to spend it on their first home. They might have other plans. So make sure that your feelings are aligned. So I would suggest weighing up the benefits of the junior ISA against the savings account, or indeed a pension. Not many people think about a child's pension. So we're going to have a look at that one now. So tax planning and financially supporting somebody in later life are 2 reasons why you might want to contribute to somebody else's pension. Now, as you may know, when you put money into pensions, there's tax relief on the contributions that are paid in. The pension fund then grows tax-free. And then when the person who has that pot of money draws out of that cash when they get to retirement, up to 25% of the pension pot can be taken tax-free as well. Pensions are the most tax-efficient way of saving in the UK. Now, if you decide to gift money into somebody else's pension, these contributions are treated as if they were paid by the individual themselves whose pension is in the name of, and tax relief will be given at their highest rate. So if you make contributions into a pension for either a non-earning adult or a child or a grandchild, for example, then you are restricted to how much you can put in, and that restriction is £2,880 per year. And the reason for that is the government still apply tax relief, even though that person is a non-taxpayer, and the government apply 20% tax relief on top. So actually, for you paying in £2,880, that person will get £3,600 into their pension, and you can do that every year if you want to. If you've decided that you want to pay into a pension for somebody who is a working age adult, they have got an income, it might be a son, it might be a daughter, then they will be able to claim tax at their highest rate. If they're a basic rate taxpayer, it will be applied automatically. If they are a higher or an additional rate taxpayer, they can claim the difference in the tax that's owed to them through their self-assessment tax return above that basic rate that's automatically given. So it can be a really lovely way to save for somebody else's future, and it enables them to get tax relief as well. But do remember that any contributions you make to somebody else's pension that is not covered by that small gifts or the annual exemption it will be treated as a gift for inheritance tax purposes if you were to die within 7 years of making that contribution. Right, the last gifts I want to cover today are gifts to charities. Now, to encourage more people to leave money to charity, any cash or any physical asset that you leave to a qualifying charitable body, either during your lifetime or in your will, is going to be totally exempt from inheritance tax. The other benefit is that if you make any donation during your lifetime, there will be income tax relief as well. Now, if you make a donation to charity directly from yourself, that's already come from taxed income. But once you pay over that, that donation, or say, for example, you take clothes into a Farley hospice shop, something like that around the country, then you can fill out a gift aid form, which means that the charity benefits from that automatic 20% basic rate tax relief on your donation. If you are a higher rate taxpayer and you've allowed that charity to claim the gift aid to boost up their contribution, then you can actually claim the difference between the 20% basic rate tax relief that the charity's received and the 40% tax relief overall that you're entitled to, again, by doing that through your self-assessment tax return. So you'll get an additional 20% tax relief on that contribution that you've made. If you give money to charity through payroll giving, which lots of employers have got set up now, which means that your money's automatically deducted from your gross salary and paid over to that charity, that deduction comes out of your salary before the deduction of tax and national insurance. And therefore you get the full benefit of the tax relief at source because it's coming out of gross income before tax and NI are calculated. Now, this is going to be particularly valuable to you, seeing as we've potentially got national insurance increases coming in April of 1.25%, although I do believe the Chancellor's talking at 1% to let us know whether he's going to delay those NI increases or not. So we'll see what happens in 10 minutes' time. But that is one real advantage of payroll giving, is that you don't pay any tax or national insurance on that contribution that you make. Now, if you do decide to bequest money to a charity in your will, if you actually give as much away to a charity that is 10% or more of the net value of your estate, it does mean the government give you some reprieve on inheritance tax, and they reduce the amount of inheritance tax due from 40% down to 36%, which for people with large estates can potentially save thousands of pounds. And this is just one of the reasons why in the UK we donate over £10 billion a year to charities. So some real advantages there of giving to charity, both in terms of income tax while you're still alive and the inheritance tax that's due from your estate after your death. Now, I did just want to finish off by talking about why a will is so important. And the reason it's important is because it tells people two things. Firstly, who you would like to have your money, property and possessions when you die, and all of that collectively is known as your estate. And the will is the place where you can set out any gifts that you would like to make in the event of your death to either people or to charities. Secondly, your will set out who's going to be in charge of organising your estate and following the instructions you leave in your will. And those are the people that are the executors. And these are the people that are going to be responsible for completing that probate process and filling out those inheritance tax forms that go to the taxman. You can also use your will to tell people about other wishes that you have, things like instructions for your funeral or what should happen to your pets after you've gone. And it's going to be particularly important if your situation is complicated, such as you're not married or you're not in a civil partnership, or maybe you've got divorced, you've got stepchildren, assets abroad, those sorts of things. And the reason for this is that if you don't leave a will or that will is not accepted, the government will dictate what happens to your money according to the laws of intestacy. And those laws might not be in line with what you want. For example, if you are just living together and you're not married, your partner won't get anything from your estate if you don't have a will in place. And last year, really sadly, the government received about £17 million in inherited property and assets because people hadn't made their wills and they had no close family within law that meant that they inherited. Now, with regards to probate, just going back to that, you might be thinking, well, what happens if there isn't a will? Who actually does those probate forms? So it's actually the most entitled inheritor that can apply to become the administrator of the estate. So that's most likely to be the closest living relative who's going to inherit the most amount of money under those government laws of intestacy. So that's normally the husband, the wife, civil partner, followed by any children over the age of 18. But of course, if you don't have a will, if you don't already have executors, that can be a really drawn out process for your nearest and dearest. So it's a much easier process if you've got the will done and the executors have already been named. So a will not only allows you to set out the gifts that you want to make, but it's going to protect your family and your heirs, and it's going to avoid that family stress of applying to be the administrator of your estate when your family are already going through a difficult time. Now, if you need some help on where to go in terms of writing a will, and you're a member of the ICE-BEN Fund, you can access some more information about wills and inheritance at their online wellbeing resources, and I've put the links here. I've also included the helpline number for ICE-BEN Fund at the bottom there too. But really excitingly, watch out in this year, probably about May, because there is going to be some new information about a new will writing service, which is going to be introduced for members. If you're a member of Support Network, they've partnered with Law Express to give their members access to free legal advice 7 days a week. Not only do they give guidance over the phone about bereavement, wills, powers of attorney, but also on a whole host of other issues such as employment, family and relationship difficulties as well. When they call you, they will be asking some questions about the nature of your inquiry so that they can best match you to the advisor that can help you. Now, just to finish off, I just wanted to draw attention to the fact that many charities will offer a free will writing service by solicitors. In return, of course, they hope that you're going to make a donation or a bequest to their charity. I've named a few on the slide here, but it is worth looking at Money Saving Expert website, where you'll find a full list of the charities that take part. And there's also Free Wills Month in March and October, so we're coming to the end of that in March. And this is for anybody aged over 55. You can get a solicitor drafted will for free, again, for a bequest to charity. It's going to depend on what area you live in as to what month will apply, so do take a look at that website. There's also Will Aid, which is very similar to Free Wills Month. That runs in November. It's open to anyone of any age. So again, go onto their website, put in your postcode, and it will tell you any solicitors near you that are participating. So just to finish off this morning, I've just put up the details of the ICE-BEN Fund and Support Network who have sponsored this webinar today. They can both provide you with financial, workplace and wellbeing support to you and your families. So I've put their website and their helpline numbers here so that you can find out more. Right, Sarah, that's all from me. Have you had any questions, Doreen?
Thank you very much. That's plenty to think about. We have had a few questions come in. So first of all, I was born in the UK but live in Cyprus. I own a home in the UK and have bank accounts in both Cyprus and the UK. How does this affect my UK inheritance tax liability?
So if you're living in Cyprus at the moment, I think this is quite a complicated area, actually, and you might need to speak to an advisor who specialises in people that have income and assets in 2 different countries. My understanding is that if you're giving UK assets to somebody who lives in the UK, then you will be governed by the UK gifts and exemptions and inheritance tax rules. If you're obviously using assets held somewhere else to give to somebody in the UK, then different rules will apply. But yeah, please do take specialist advice. You can go onto the unbiased.co.uk website, and that will tell you if there's any advisors in your area that specialise in people that have got assets in 2 or more different countries.
That's great, thank you. Can a lifetime ISA be used by a parent to assist with the purchase of your child's first house? For example, tax paid from a pension into a child's lifetime ISA.
Absolutely, yes. It's just that you wouldn't be able to set it up on their behalf, because lifetime ISAs can only be set up once the child has reached the age of 18. So if they don't know how to set one up, you would need to help them set up, but they would need to do it in their name. But once that lifetime ISA is in existence, let's say, for example, you were taking tax-free cash from your pension and you wanted to gift that over to your child for them to put into their lifetime ISA, because if they put it into their lifetime ISA, they get a 25% government bonus, then absolutely you're more than entitled to do that. And that's a really tax efficient way of helping your child, because they get that 25% bonus as well.
That's great, thank you. And can a junior ISA be given by grandparents?
Yeah, do you know, I was going to double check this because I think the rules have changed. I do believe that you need to set up an ISA now for a child, a junior ISA, you do need to have parental responsibility. So the grandparents would need to liaise with the parents in order to set up, if the grandparents, in some circumstances, it's grandparents that are looking after children and have the parental responsibility. But if not, get the parents to set it up. And then, of course, the grandparents can pay into it for savings.
That's great. Is the £3,000 per annum per giver or per recipient?
It's per giver. So that is your personal gift allowance for the year. You can give £3,000 out of savings or out of anything that you want to a person or people of your choice. So let's say you made 3 gifts of £1,000 to different people. That would all be exempt because that's your annual gift exemption.
That's great. Can you expand on gifts from excess income?
Yes, so all we're saying there is, say, for example, you are a grandparent and you are wanting to save for your grandchild's future. As long as you can prove, if you're putting, let's say, £500 a month away for them, as long as you can prove that that's coming out of income that you're receiving, potentially from pensions, like state pension and your private pensions or your workplace pensions, and that it isn't affecting how you live day to day, then it will be exempt from inheritance tax. If, however, you are taking that money out of savings that you have to give to your child, then that can be seen that you're trying to avoid inheritance tax, and therefore that could potentially be liable to inheritance tax if it goes above your annual exemptions. I hope that makes sense. So, as long as it's not seen that you're just trying to move money away from your estate to somebody else's, but if you're paying it out of income, it's surplus income, you don't need that for your essential living, then basically HMRC say that's fair enough. You're not trying to just move across savings because you don't want them in your estate.
That's great, thank you. And we've still got another couple of moments. So can I pay for my child or grandchild's university education without them paying tax or incurring inheritance tax bill if I die within 7 years of them graduating?
Yeah, so this comes back to giving them money out of your income rather than your savings. Obviously, you can use your £3,000 a year annual exemption for your grandchild, so you could do that, give them that. But anything else that you give them, you would have to be able to prove that it's coming out of your surplus income. If obviously you then decided to pay off things like student loans, if you were to die within 7 years of making that, that would potentially be taxed, have inheritance tax on that.